If you're a crowdfunding entrepreneur or investor, some new rules could be on the horizon. In case you didn't get a chance to read that nearly 600-page proposal by the U.S. Securities and Exchange Commission, here's some of the highlights. The biggest changes are for investors. Under the proposal, people of all income brackets would now be able to invest in privately held companies. It was previously reserved for those earning over $200,000 a year or with a net worth of $1 million. Investors won't be allowed to sell or transfer their stake within a year of purchase. Meanwhile, crowdfunding entrepreneurs can raise a maximum of $1 million a year from the public. Businesses with a round of funding over $500,000 will now have to present audited financial statements each year until they go public, go bust, or get acquired. But if you're eyeing foreign companies, they will not qualify for crowdfunding, and neither will some investment firms and businesses already reporting to the SEC. And for more on the expansion of crowdfunding, we're now joined by Brian Korn, attorney and counsel in the Corporate and Securities Practice Group of Pepper Hamilton. Thanks so much for joining us this evening.
My pleasure, Michelle.
So, Brian, under the new SEC proposal, startups and small businesses could sell ownership stakes in their companies by soliciting investors over the internet. What are the implications of this proposal?
Well, it has tremendous potential to open up investments in small startup companies to the entire general public. The SEC in its report noted that only 7% of Americans actually qualify as accredited investors, which is that $200,000 or $1 million net worth test that you referred to earlier. So this has a proposal this has potential, obviously, to open up the investments in these smaller companies to the other 93% of the public that currently can't engage in crowdfunding.
So it'll make it easier for investors. It'll also make it easier for startups to get their funding. But aren't there some contentious issues with regards to this new proposal and protecting the public?
Well, absolutely. There are people who object, firstly, that crowdfunding to the general public actually puts venture capital and smaller startup investments at the doorsteps of the moms and pops who can least afford the loss. Startups are very risky investments to begin with, and when you take the companies that aren't able to get venture or mainstream startup funding or even accredited investor crowdfunding, then you actually take an even riskier slice of those investments and you lay them at the steps of the mom and pop investors.
Now, we're talking about those mom and pop investors, and the crowdfunding rule would let businesses raise up to $1 million by tapping those unaccredited investors. So what protections would be in place to look out for the small investor? Because my understanding is that the onus is on the businesses to make sure that these people fall within that and that there's no major compliance obligation at this stage.
Well, it actually is a very expensive process, and one that it was really imposed not necessarily by the SEC, but by Congress through the Jobs Act in April of 2012. Companies that want to do public crowdfunding and go out to non-accredited investors are going to have to pay a very heavy price. For example, they can only raise, as you mentioned, up to $1 million. There are caps on what an investor can invest. The company has to have a disclosure document similar to an IPO prospectus that we've been talking about with Twitter. It has to be sent to investors within 21 days and filed with the SEC. The company must continue to make annual report filings with the SEC. And there are numerous other requirements. You must use a broker-dealer or a funding portal, which has to verify that the investors qualify for crowdfunding and that they haven't exceeded their maximum investment thresholds.
And who would be overseeing this compliance and regulation? Would it be the SEC?
Correct. So the SEC has created funding portals, or a broker-dealer that's currently in place can register as a crowdfunding intermediary. And funding portals will register with FINRA, which is the organization that already oversees broker-dealers. FINRA put out a release of funding portal rules last week, which essentially lays out the groundwork for what I would like to call broker-dealer light. Funding portals can do much of the same things and have to comply with much of the same supervision and testing requirements that regular broker-dealers have to comply with. And these funding portals for each transaction have to verify that the investors understand that these are risky investments and maintain and ensure that each investor has not exceeded their crowdfunding cap, which for people below $100,000 is a maximum of $2,000 across all of your crowdfunding investments over the past 12 months.
Well, Brian, this proposal is still not confirmed yet. When will it be confirmed, and what needs to happen for this proposal to become official with regards to the SEC?
Sure. So there's a 90-day comment period which will run until the end of February. The SEC staff then has to read all of the comments and compile suggestions, and then make an adopting release proposal to the SEC, which is a 5-member panel. And at a meeting of the SEC, the rules will finally be approved for release, and then there'll be a 30-day to 60-day phase-in period before they go into effect. So my best guess is you won't see final rules go into effect until June or July of 2014.
All right, we'll have to wait until then. We're going to have to leave it there, though, for now. Brian Korn, attorney and counsel in the Corporate and Securities Practice Group of Pepper Hamilton. Thanks so much for joining us tonight.